Hey warriors, I hope you're all doing great. So this is a video for all my students who are appearing for the CA and CMA final examinations, which is coming up for your December 25 and Jan 2026. I know your exam dates have already been announced, so I'm really hoping you all are doing an extreme amount of preparations for getting through these examinations. I know CA final comes with its own challenges and journeys, but nevertheless, trust me, if you have already crossed inter, CA final is just a step ahead. You just have to put a little bit more attention and interest, and you should be able to do a better job. To help you ease your preparations, what we have come up is to discuss on the amendments of the current year. Now, if I have to move you from the September 25 to Jan 26, the amendments are quite hardly enough. Yes, you have like one or two amendments which are there, especially something called safe harbor rules being introduced. But if I look at on a consolidated level for all students who have not even appeared anything from May 2025, which means the previous thing which you would have learned is probably the November 24 examinations. In that case, yes, this year you have quite a few amendments which has to be kept in mind. So I took some additional time and additional efforts in order to prepare a complete amendment related document for all of you. A very one-shot document, people, where you have about 28 sides, if I understand this correctly. So about 28 sides where we'll be discussing all the amendments which you have for your examinations if you are applicable for December 25 of CMA and Jan 2026 of your CA final examinations. Yes. Now, why am I paying too much attention to this? It's very simple. May 25 and September 25 have been a very good evidence, people, that ICI is at least testing about 4 to 6 marks from amendments itself, which means you have to pay attention to the amendments which ICI is releasing, especially the latest ones. That is what is being paid more attention to. So it's very important and critical that you pay attention to these amendments so that at least the 4 to 6 marks can be easily scored off. And trust me, people, except for the capital gains part of it, most of the amendments are manageable. It's just that it's a little critical and important, so it may take additional efforts for you. And this PDF should definitely do the trick for you. What we have done in this PDF is not just to give you the amendment, but also give you a little bit of a background on things here and there so that you are able to relate to the amendment even better. And in this video, what we're going to do is we're going to ask and understand all the amendments which are relevant for your examinations, all highlighted in green for your reference point so that you can easily understand all the amendment related topics in each chapter of. Yes. Now, depending on the time which takes to complete these amendments off, we may split it over multiple parts as well. But I am trying my level best that I keep it very simple and relaxed because I know you are already in the middle of your preparations. It may take a little bit of an extra time for you to go through the video. So I don't want to make this video too long enough that you have to waste your time on this. But at the same time, it is my duty that I don't just explain the amendment, but I also make you understand how to read the amendment for your examinations. So wherever appropriate, we will also be doing some example illustrations so that you can understand the amendment a little more critically well enough for your examinations. Are we going to do that accordingly? Yes, perfect. So what we're going to do, people, is we're going to look into this all amendments very carefully one by one, and I'm going to try to make you understand what exactly are the amendments relating to. At every appropriate stages, I'll also try my level best that I can start marking a few important things in the amendments itself, which means you don't need to pay too much attention to every single line which is given there, but at the same time, the smaller pieces which are more critical so that you pay more attention to those things. And if a MCQ related question comes in exams, you're able to answer it then and there. Yes, these will be really important and relevant if you're going to look into the big amendments like search and seizure kind of amendments. There we really don't want to spend time looking into every single line item, people. We will try to mark a few things here and there so that you know for examinations, yes, this is the point which I pay attention to. I should be able to answer my answer paper off. Yes, so that is what we're going to do. So yes, it's not just going to be discussion of amendments, but it's also about parallelly creating a cheat sheet for all your reference points. So let's do that accordingly. Are we making sense? Amazing. Let's start with that understanding. Amendments of your December 25 and Jan 2026 examinations. First and the foremost thing, people, when you end up taking up this chapter, you need to understand that chapter number 1, basics of tax, would come and clarify to you that in the current year, when you're going to appear for December 25 and Jan 2026 examinations, the Finance Act which is going to start applying to you is going to be Finance Act 2024. Yes, so Finance Act 2024 is what you're going to be reading for your examinations. But yes, you also should be aware about the fact that in the current year, you had another Finance Act which came into picture, which was Finance number 2 Act 2024. Finance Act 24 technically has no big amendments, people, except for changing a few due dates. On the contrary, Finance number 2 Act made the significant amount of changes relating to search and seizure, capital gains, and everything else which we're going to discuss in this topic of. So you have to pay attention to that. But the most critical part is this here. When you talk about amendments of the current year, you are going to be writing exam for assessment year 25-26 and not for anything else. Yes, so you're going to pay too much attention to all amendments which are happening in assessment year 25-26 for your examinations, which means all your questions in your examinations are going to be relating to previous year 24-25. Yes, so please pay attention to the fact that you're only going to be reading 24-25 with 25-26 assessment years. If you see any other adjustments coming up in exams, be very careful on the dates which are given in the question. Yes, sometimes ICL loves to confuse you with the dates. They may start giving you dates of 23-24 or for 25-26 previous year, which you don't want for your examinations. So pay attention to the fact that you're only looking at relevant rules relating to previous year 24-25, assessment year 25-26. Are we making sense? Amazing. With that, people, we are moving on to rates of taxes. The amendments which is coming to rates of taxes is very specific on capital gains. The capital gains amendments of the current year come and tell you what? They say that when you're going to do a capital gains in the current year, you will have to tell me when do you end up doing the transfer. If the transfer is happening before 23rd July, in that case, I will come and say you have to take the tax rates as per the old rules. But if you're doing the transfer on or after 23rd July, the tax rates will be as per the new rules. Quickly help me out, people. I'm sure you're already aware about the tax rates. What are the tax rates? If I take 112A, the tax rate is going to be 10% before 23rd July, 12.5% after 23rd July. But both of them together is going to be in excess of 1.25 lakhs. Then if I go to 11 the tax rate was 15% before 23rd July and 20% from 23rd July. But if I'm going to 112, then it's going to be 20% before 23rd July and 12.5% after 23rd July. Yes, so these are the tax rates which you have to keep in mind, people. What is it? It is 10% before 23rd July, 12.5 after 23rd July, 20 before 23rd July, 12.5 after 23rd July, and then we have 15 and 20 for 111A cases. Yes. The most important critical part to be understood is that the rates of 112A is after claiming a 1.25 lakhs. Now, what you need to understand is this 1.25 lakhs is not just for the old, neither for the new, it's together. It's together, which means in the year, if you have made an income of 7 lakh rupees, whether it is from old dates or from the new dates, 1.25 will be removed off and the balance is what you can claim tax rates on. The balance is what you will have to decide as to what period does it pertain to assess the tax liability. Yes. Now, this is not something which has been tested in exam and unfortunately should not be tested in exam also. But nevertheless, if a question like this comes, imagine a case where you get a question where the question comes and says a person is having LTCG under section 112A, which is almost for about 3 lakh rupees. The person also has an LTCG under section 112A for about 4 lakh rupees. But the first 3 lakhs was accrued before 23rd July, whereas the next 4 lakhs was accrued after 23rd July. Yes, this is what the facts is, which means in the same year, this person has made a transaction twice, something before 23rd July and something after 23rd July. In this case, how do you tackle this question is the bigger issue, because if you notice, for the 7 lakh rupees, I need to be exempting 1.25 lakhs. Now, this 1.25 lakhs which I'm going to exempt off, should I be exempting from the prior one or from the newer one is the question mark. Yes. Now, I have two school of thoughts on this, and this is my personal opinion as a faculty. Option number one, you can go for FIFO method. You can go for FIFO method. In FIFO method, what will you do? You'll simply come and say the 7 lakhs which I've got, I will have to first adjust it against the original, the first income which I accrued off, and therefore I will reduce this 1.25 lakhs from the 3 lakhs here. Yes, so if I take away 3 lakhs from 1.25 lakhs, help me out, what is going to happen? I'm going to take 3 lakhs from 1.25 lakhs, answer is going to become 1,75,000. On this 1,75,000, I'm going to be taxing at the rate of 10%, which means the answer is going to become 17,500 rupees. Because I am now looking at the balance income having no basic exemption pending, the whole 4 lakh is going to be taxed at 12.5%. So I take the 4 lakh and tax it at 12.5%. Answer becomes 50,000 rupees. This is your answer for 67,500. This is the answer for 67,500, and yes, you can automatically add cess and everything on it. That's not the discussion here. But the more critical thing is on the option number 2. Yes, option number 2 is what you have to pay more attention to. In option number 2, I can say what is best for the assessee. I can say what is best for the assessee. Understand this carefully. If I end up removing the 1.25 lakhs from the original one, the 3 lakh rupees, the problem what happens is I only get a shield of 10%. But if I end up reducing this from the second income, I end up getting a shield of 12.5%, which means a person would like to claim more benefits than give away more taxes. Agreed? So here is an option number 2. I will try to set off the 1.25 lakhs against my second income and not my first income. Because I'm going to set it off against my second income, on the 23rd July, I will be taxable at the rate of 10%, which means the answer becomes 30,000 rupees. But on the post 23rd July, I will be taxable after reducing a 1.25 lakhs, which means take away the 4 lakh rupees, reduce 1,25,000, answer becomes 2,75,000. On this comes 12.5 percentage, which gives me 34,375. Yes, 34,375 gives me 64,375 as my tax liability. So notice what is happening carefully, that if I choose option 1 and I reduce it from my FIFO basis logic, I am ending up paying more taxes. Now Rahul, for an exam, which one is right answer? They both are right. They both are right. If you do get a question like this in examination, I would strongly recommend you do any one of the two, but properly give notes against it. Yes, if nothing has been clarified by ICI yet, ICI will not try to trap you into giving only one of the two answers, which means ICI should be comfortable with either of the two answers when there is an ambiguity to that extent. Yes, so perfect. Please take that into consideration before you go forward on your computation model. Are we clear? Perfect. The second and the most critical thing is on the domestic company and the foreign company tax rates. Firstly, on the domestic company, in the current year, if you want to tax it at the rate of 25%, the previous year turnover of 22-23 has to be taken into consideration. So I will take the previous year 22-23 order turnover. If the 22-23 turnover is less than 400 crores, I will be taxable for 25%. Otherwise, I have to tax it at 30%. But the most critical amendment of the current year is on the foreign company tax rates. Please do expect a question in exam on the non-resident taxation this year relating to a foreign company, because current year, if you are a foreign company, you're going to be taxing it at a rate of 35%, which has gone down from the 40% earlier tax rate. Yes, so this becomes extremely critical. Now May 25 and September 25 has not seen a question regarding this coming up in examinations, so there is a very high possibility that this will be picked up in the Jan 2026 and December 25 examinations. So please pay too much attention to this amendment very carefully. Yes, this is what the tax rates is, people. Any doubts? Perfect. With this tax rates being done, we are now moving on to what is called as a special tax regime, where in special tax regime, the most critical amendment has come in section 115 BAC. What does section 115 BAC come and say? When it comes to section 115 BAC, the provisions now come and say that when you want to do the slab model, the slab model is not an incremental 3 lakh rupees. The slab model is a slight changed model now. The slab model now comes and says, for the first 3 lakhs, I will be taxing no incomes. Yes, after that, for the next 4 lakh rupees, I will not be taxing. I will be taxing at the rate of 5%, which was earlier 3 lakh rupees is now 4 lakh rupees. So which means for the next 4 lakh rupees, I'll be taxing at 5%. For the next 3 lakhs, I'll be taxing at 10%. Again, coming back to a 2 lakh model and then removing back to 3 lakhs. And then removing back to 3 lakhs. So it's a model of 4, 3, 2, going back to 3 and then moving on to balance. Now, if you understand this carefully, people, how does it going to look like? It's going to look like reading. For the first 3 lakhs, there'll be no tax. From 3 lakhs to 7 lakhs, it's going to be 5%. From 7 lakhs to 10 lakhs, it's going to be 10%. 10 lakhs to 12 lakhs is going to be 15%. 12 to 15 is going to be 20%. And then after 15, you can claim 30%. After 15, you're going to claim 30%. Repeat it once again with me, people. For the first 3 lakhs, it's going to be no tax. From 3 lakhs to 7 lakhs, it's going to be 5%. 7 lakhs to 10 lakhs is going to be 10%. 10 to 12 lakhs is going to be 15%. 12 lakhs to 15 lakhs will be 20%. And then after that, everything becomes 30%. This is your new slab rates for your 115 BAC. Now, obviously, 115 BAC as a regime is only tested in double taxation relief questions. So please expect this to be a part of a double taxation relief question for your examinations. Yes, so that is what the slab is. But beyond that, what is more critical, people, is some changes which has been made. Change number 1, income tax in the current year comes and clarifies that if a person is going to opt for new tax regime, until last year, you could only deny some benefits to income to people opting for 115 BAC. But in the current year, if you're opting for 115 BAC, I have extended additional benefits to you if you opt for new regime. Benefit number 1, if you are going to be taking up new tax regime or the default tax regime, your standard deduction has now increased from 50,000 to 75,000. Yes, which means now if you're a person opting for older regime, you'll be getting a deduction of 50,000. Whereas if you're a person of new regime, you'll be getting a deduction of 75,000 rupees. Yes, amazing. Second, if you're going to be a person who's going to receive any amount in family pension, then you'll be allowed a deduction of 25,000 rupees as against the 15,000 which was given earlier. So earlier you would have claimed only a deduction of 15,000 rupees, but now you can end up claiming 25,000 rupees as a deduction. What is the family provision rules? If you remember, people, it is 1/3 or 15,000, whichever is lower, has now converted to 1/3 or 25,000, whichever is lower, if you're opting for new tax regime. And the last and the most critical amendment, people, is that when you are going to have a old tax regime to new tax regime transition, people opting for new tax regime under section 80 CCD, whatever employer contribution you were able to claim, you can now claim it up to 14% of salaries. Yes, so up to 14% of salaries is what you're eligible to now claim under ATCCD subsection 2 under the new tax regime, which means under the old tax regime you'll still remain at 10%, but in the new tax regime you're going to move away to 14%. Now, yes, let's understand this also. When I talk about the word salary, salary basically means basic pay plus DA forming part. Yes, this is the definition of salary, so you have to keep that also into mind when you compute the deduction of. Clear? Yes, perfect. That moves me to the chapter number 6, which is talking about PGBP. What does amendments in PGBP look like? First and the most critical amendment this year comes and clarifies that if you are going to be in the business of letting out properties, you will have to decide whether you are doing it as a residential house or you're doing it as a commercial house. If you're going to let out a residential house, even if you are in the business of letting out, you are still going to be taxable under HP. You cannot be taken to PGBP, people. This is an overturn of the Chennai properties case law, which has come up last year, which was come up before Supreme Court. This year amendment comes and clarifies that if you are going to be in the business of letting out residential houses, you are going to go to HP. You cannot be under PGBP. Yes, which means the only person who can claim a taxation under PGBP will be those persons who are letting out a commercial property as a course of his business. If you're going to let out commercial property at a course of his business, then it is going to be PGBP. Otherwise, you're going to switch to HP. Yes. So if I have to create a small transition sheet for you people, I'm going to ask you a very simple question. Tell me what kind of property do you have? Tell me what kind of property do you have? If you tell me that you have a residential property or do you have a commercial property? What do you have? Do you have a residential property or do you have a commercial property? If you're going to be in residential property, there can be two things. Either this is your business or it is an others activity, which means you're either doing it as a business of let out or you're doing it as an other activity. If you're in a residential house property, if you're giving away residential house property as a business, it is going to move to HP this year. The amendment of the current year clarifies this moves to HP now. Anyway, others was a part of HP only, so it was never a discussion. It was always taxable as HP. On the commercial side, I am now going to ask you the same question. On the commercial side, tell me, are you in the business of let out or are you doing it as a commercial property? If you tell me that you are in the business of let out, this is where the challenge is. Income tax has only made an amendment for residential property, which means this continues to remain under PGBP, whereas if you're doing it as others, then there is no conversation here, it is going to go to HP. It is going to go to HP. So which means you have to keep this attention in mind, people, that when it comes to business of residential house property, this has now gone to HP chapter of and is not under PGBP. Whereas if you are into commercial properties, it is still remaining under PGBP, provided you are in the business of letting out. If you're not in the business of letting out, that is not a conversation, then it is under HP chapter of. Yes, amazing. This is what the amendment is. Now, expect this question as an MCQ format, people. In MCQ, they can ask you very, very good format questions where they can come and say that I'm a manufacturing concern letting out a property. Understand, if you're a manufacturing concern letting out a property, you were never in the business of letting out, which means it was traditionally always HP, will continue to be HP. If the question says, no, I am a person who is letting out commercial properties, and it is PGBP. Whereas if I'm in the business of letting out residential properties, I will move now to HP chapter of. That is what the amendment is. Are we making sense? Perfect. If you want, you can note down the chart, people. This is very beautiful chart for you to understand the amendment very carefully. Great. The next amendments are under PGBP in computational provisions. First amendment, which was made in consequence of the amendment which was made in new tax regime. As you all know that when it comes to new tax regime, under NPS ATCCD2, now you can claim up to 14% of deduction. And therefore, to ensure that the employer also gets a similar amount of deduction, income tax comes and clarifies that if an employer is going to give any kind of contribution to NPS, he can claim a deduction up to 14%. So the amendment is here. You can claim a deduction up to 14%. Anything excess which you pay is alone going to get disallowed under PGBP chapter of. Until last year, this was 10%. Now it has become 14% for your computational purposes. So please note that when an employer is going to give any NPS contribution in the hands of employer, the expense can be allowed only up to 14%. Anything excess will be allowed, anything excess will be disallowed. The catch point is here, people. Imagine if I give you a question. Where I say a company called A Limited is giving an employee rupees 1,40,000 as NPS for his salary of 10 lakhs. for his salary of 10 lakhs. Employee is opting out of DTR. Employees opting out of DTR. Imagine if I give you this example, people, where I come and say that an employer is planning to give any kind of NPS contribution of 14 lakh rupees to the employee earning a salary of 10 lakhs, whereas the employee is deciding to go for ATR. Now, for those who think about it, you will tell Rahul, ATR is still a 10%. Yes. So you will say an employee can only claim 10%, which means employer should also be disallowed for 10%. Answer is no. Answer is no. Please note that the amendment comes and clarifies a flat to 14% reduction for the employer. At no point of time does the section come and say that the employee should be checked for the regime, which means I will standardly give you 14% as an employer, whether or not the employee chooses new tax regime. Yes, which means in this case, even if the employee goes for choosing ATR, it does not matter. Fully claimable for the employer. Fully claimable for the employer, because at the end of the day the employer has paid 14%, which is within the limits. On the contrary, for the employee, what is going to happen? For the employee, he will tax the 1,40,000 under salaries. He will tax the 1,40,000 under salaries, whereas when it goes to 80 CCD deduction, he will only claim 1 lakh rupee. He will only claim 1 lakh rupee, because that is what is eligible as he being old tax regime. Now, understand this carefully, that it doesn't matter what the employee is doing, whether the employee goes for old tax regime or new tax regime, the employer deduction is fully claimable. It has no restrictions here because it is sitting within 14%. Even though employee may be eligible only for 10%, an employer continues to claim the full 14% as a deduction in his PGBP computation, because 14 is what he is permitted to do. Yes, please mark this one as very, very important. This is a very, very small thing which you should be paying more attention to. Yes, so be very careful about this as an example of. Clear? Amazing. Moving on forward to the other adjustment, people. The other adjustment is in section 37. Now, section 37 had an amendment in the current year which came and clarified that if you're going to incur any expenditures for settling any proceedings of an act, you will be not allowed as a deduction, because that will be tantamounting to an offense payment. Yes, what was amendment, people? Any expenditure made for settling a proceedings under an act will not be treated as an expenses. The problem what happened is the act was never notified. Yes, and therefore income tax subsequently came up with the notification where they've now come and clarified what kind of acts am I talking about. Acts are like this. It says when an expenditure is incurred to settling proceedings, for what are the acts? We have SEBI, Securities Exchange Board of India, SCRA, Securities Contract Regulation Act, Depositories Act, Competition Act, then you will not be allowed as an expenditure, which means if you settle proceedings under any of these 4 acts, then that will not be allowed as an expenditure. You cannot claim those as an deduction. Any other act, yes, it's still not notified, so you probably can dwell upon it as long as it is not a penalty payment. If it is a penalty payment, there is no conversation, it is always disallowed. But if it's some expenses which you are incurring to settling a proceedings, only 4 expenses has been notified of. One is payment to SEBI, then is SCRA, then is depositories, and finally to what we call as Competition Act. In these 4 places, whatever payments you're going to make will not be allowed as deduction if it is for settling a proceedings. Clear? Yes? Perfect. That moves me on to what is called as the capital gains. Capital gains has the most amount of amendments in the current year. Although, yes, if you come and ask me, I would say as a CA final student, I don't expect capital gains to be the most important thing for you to read on, because it's more tested at inter-level. But with the amendments which has come up, people, silently what has happened is the amendments have also come in non-resident taxation, which means I now expect that the capital gains provision is more relevant to your non-resident taxation, where you should be paying more attention to. Yes, so we alluded to that extent, people. The non-resident related capital gains provision is something which I will discuss subsequently with you. So we have it as a part of the non-resident taxation topic, so we'll be discussing it there. Right now I'm only trying to give a generic understanding of what the amendments are. Amendment number 1. First, income tax has made changes in the classification of capital asset. Until last year, we had 3 slabs. One was 12 months, one was 24 months, and then there was 36 months. In the 36 months, we're sitting 3 items. Item number 1 is what we used to call as units of business trust, and item number 2 was what we call as any kind of other capital assets. Generic, whatever assets were there, were sitting in 36 months. Now, in the current year, income tax decided that whatever is the business trust which you have is anyway linked to 112A, and therefore they decided that the 112A will now cover of all 12 months categories, which means business trust units was moved to 12 months. At the same time, whatever is the other capital assets, they ended up moving to what we call as 24 months. Yes, so that is what the small change which we did. The 36 months related two items, which was units of business trust, shifted to 12 months, and the other assets shifted to 24 months. But the only catch point here is this all happened after 23rd July. This all happened after 23rd July, which means if you are an asset holder before 23rd July, if you have sold these assets before 23rd July, the old rules will apply. What does the old rules, people? The old rules come and say that any kind of transaction which took place before 23rd July, for these two assets alone, I'll have to take 36 months. I'll have to take 36 months. That is what the amendment is. Yes, so you will take 36 months for those cases which are before 23rd July, and after 23rd July you can take them cases 12 months for business trust, 24 months for other items. Yes, these are the only two critical amendments. Everything else remains the same, which means if I'm going to have listed securities, it is 12 months. If I'm going to have zero coupon bonds, 12 months. Equity oriented funds will be 12 months, and then any kind of union trust of India units is also going to be 12 months. Immovable property sits at 24 months, and that is what the provisions is along with unlisted securities. Last thing to be kept in mind is on the critical part of the fact that when it comes to slump sale still remains at 36 months. There is no change in slump sale, people, which means slump sale is now the only item which is sitting in 36 months and has much attention to. So expect this also as a question in examinations. Yes, so you can expect a question in examinations where it will come and clarify that you have a slump sale. You will say slump sale will automatically be taxed at 36 months and will not be taken anything prior to that. Yes, this is what the amendment is. The first amendment called as classification of capital assets. Clear? Yes, good. That brings me to second amendments, which is transactions not regarded as transfer. Now, in the current year, income tax has come and clarified that when you give a gift, you are normally not liable for capital gains. But in the current year, it has come and clarified saying a gift can only be given by an individual or an HUF to another person. Yes, which means if I'm going to give a gift to by an individual or HUF, only then it is not regarded as transfer. From the current year, if anyone else gives a gift, then it is regarded as transfer. So if you see a question which comes and says any company is giving away a gift, it is taxable as in capital gains unless it can be proved that the other person is a wholly owned subsidiary. If the other person is a wholly owned subsidiary, then in that case, the transaction is anyway exempted in some other clause. So you don't have to worry about that. But until that has been proved off, any transfer which takes place by a company, even if it is in sort of a gift, it now becomes fully taxable as capital gains. So that is what you have to keep in mind. Yes, yes. Good. That brings me to amendment number 3, which is on the computational model. As you all are aware, people, for those who have done inter, you would have realized that when it comes to capital gains computation, very standardly, 112 was always liable for indexation benefits. But from the current year, the fact that 20% of 112 has been shifted down to 12.5%, income tax has made it extremely clear that starting 23rd July, you are not eligible to claim any indexations. You're not eligible to claim any indexations, which means now whatever is your cost of acquisition and whatever is your cost of improvement will now be treated as is. You are not eligible to claim any indexation on these assets of. Yes, that is what the provision is going to clarify. However, you also have an additional provision which is not relevant for CA final level but is more relevant for CA inter level, which comes and clarifies that specifically for resident individual and HUF, if you are a resident individual or HUF who has bought an immovable property, which is before 23rd July and you're trying to sell it after 23rd July, it will so happen that because after you sold it after 23rd July, you will not be eligible for any indexation benefits. Yes, income tax here gives you a levy. The levy comes and says you can, if you want, decide to pay tax at 20% with indexation or decide to pay at 12.5% without indexation, whichever makes more sense to you. So as long as you are a resident individual and HUF, only for resident individual and HUF, if you are going to have a transfer before 23rd July, then it is already 20 plus indexation. But if you're going to do it after 23rd July, you can do it as 20 plus indexation or 12.5 minus indexation, whichever is better for you. This is an amendment. Now again, I don't expect this to be tested in your exams, people, because this is more relevant for your CA inter syllabus. So let's keep it to that extent. But if you get an MCQ question on this levels, please be careful about it. Yes. Good. What other amendments that we have to keep in mind, people, is the fact that when it comes to indexation rules, I told you before 23rd July, you were eligible for indexation. Post 23rd July, there is absolutely no indexation benefits. Now, what are the items on which you could not have claimed indexation even before 23rd July? These items are where you were always taxing it as cost of acquisition, despite it being a long-term capital asset. What are those assets? First, if you are going to have any kind of distribution of capital assets by a partner to its firm or firm to partners, yes, distribution of capital, distribution of partnership ratios, 45(4) is the provision coming in. There was no concept of indexation. Second, any kind of transfer of bonds or debentures. If I had any bonds or debentures, it was standardly not eligible for indexation. That was always at a gross cost level. Third, if I'm going to have any kind of transfers which is done as a share or debenture by a non-resident, if I'm doing non-resident computation, people earlier they used to come and say, I will not be eligible to claim indexation benefits when the non-resident is anyway computing the whole capital gains in foreign currency. So if you're going to compute capital gains in foreign currency, then there is no concept of indexation for you. Next, any kind of transfer of depreciable assets. The moment I do a depreciable asset transfer, people, the gains resultant is automatically treated as a short-term or a long-term capital gains. So there is no concept of you claiming indexation on this. Next, any kind of transfer happening on a slump sale, a separate topic, but yes, a slump sale topic where you will be discussing on the fact that if you're going to transfer anything after 36 months, then you take the full value of consideration minus the net worth of the business. And since you're already taking net worth, there is no concept of you applying indexation rules on this. Finally, any 112A assets. If you're going to have an assets under 112A, then there is no point of doing indexation, people, because you're anyway going to tax it at a lower rate of 10%. Ignore it off. Finally, in 112, earlier they used to come and say, when I'm going to transfer any unlisted securities by a non-resident, non-corporate or a foreign company, transferring any unlisted securities and shares, you were not required to do indexation benefits at all, because you were anyway being taxed at the rate of 10% earlier. Even now you are being taxed at 12.5%, but that's not ever the point. Yes, so you don't have indexations there. And finally, the last item is any kind of person who is having listed securities and ZCBs, if they are going to pay tax at 10%. For ZCBs and listed securities also, people, they were given a choice. The choice was that you can either tax it at 10% without indexation or 20% with indexation. And yes, most of the people had chosen 10%, which means that was the rule. But if you have chosen 10%, there was no indexation criteria anyway given to you. So that is what the rules are. Yes, so this is a small hint on what kind of assets should you not be claiming indexation, whether you go before 23rd July or after 23rd July. If you're going to have any other asset other than this, you can anyway go for indexation before 23rd July, but after 23rd July, everything has been deleted off. This is what the amendment rules are. Clear? Yes. Finally, people, when it comes to capital gains, the amendment was that the CII which was notified for the current year was 363. Although yes, this was not important at all. ICI will give you the CII in your material itself, so you can take it from the ICI question itself. But please be careful that just because ICI gives you CII does not mean you need to apply it always. CII is most often given only to confuse you in examinations. So you will only apply CII if you are going to do it before 23rd July and it is not falling in these cases. If it was anyway after 23rd July, there is no requirement for you to do indexation, and therefore you don't need to worry about this itself. Yes, yes, great. Keep that in mind, people. That brings me to your capital gains for market linked debentures or unlisted bonds and debentures. Income tax has now come and clarified that when you have any unlisted bonds or debentures which is issued after 23rd July, the asset is always now going to be a short term or a short term capital gain or short term capital loss, respective of your period of holding. I don't care what your period of holding is, I will always treat it as a short term capital gain and a short term capital loss as long as it is an unlisted bonds or debentures after 23rd July. Yes, expect a very beautiful question in examination around this, people, where what may happen is ICA may come and say that there was a debenture where part of the debentures were sold before 23rd July and part of the debentures were sold after 23rd July. At any point of time, they will make sure that the period of holding is more than 36 months. Understand, if a part of the debentures was sold before 23rd July, that was always a long-term capital gain if it ended up more than 36 months. I will not claim any indexation because that is what has been clarified above itself, but nevertheless it was a long-term capital gain. Now that I sell it in 23rd July, it will automatically become a short-term capital gain because it is post 23rd July. So that is what you need to keep in mind. Yes, so some item which is purchased before 23rd July automatically treated as long-term asset before more than 36 months, but if it is after 23rd July, it is treated as short-term capital gains always, doesn't matter what the period of holding is. That is what the amendment is. Yes, so expect an MCQ question on this in exam, people. That is what you have to pay attention to. Clear? Yes. Now you would have noticed by now, people, every time I'm doing something, I'm already starting to mark some important things. So this is the only important things you're going to read for your examinations. You don't need to pay attention to every single document text. If you're able to understand the provision, the highlights alone will give you the answer of already. Yes. Yes, perfect. Let's move on forward. Yes, moving on forward. So we have the next section called a section 54EC. Now, this is an amendment which has been specifically introduced for your Jan 2025 examinations. So please look at this very carefully. The Jan 2025 examinations now has this amendment. December 24 also can look into this. Your CMA students of December 24 and your CA final students of Jan 25 are going to look at this very carefully. This amendment of exam comes and clarifies that when you're going to have an investment in section 54EC, for those who remember section 54EC people, if you're going to transfer any kind of immovable property and in return buy some bonds, you'll be eligible for an exemption of 54EC if you purchase the bonds within 6 months from the date of transfer, and you can claim a maximum amount of 50 lakh rupees. You remember the provisions? Very good. The amendment of the current year comes and clarifies that if a person is going to invest anywhere in the bonds of National Highway Authority of India, RECL bonds, any kind of Power Finance Corporation and Indian Railways Finance Corporation, you were anyway eligible for 54EC. Now, we have also notified an additional bond for you, which is called as HUDCO. HUDCO is the bond which has been introduced for you, Housing and Urban Development Corporation of Limited. Yes, so we have now introduced something called HUDCO, Housing and Urban Development Corporation Limited, where if you invest money in HUDCO bonds also, you are eligible for 54EC. Yes, so you can now get a question in exam where they may come and transfer a immovable property, in return buy for a bonds, and the bonds can this time look like HUDCO. If you find a HUDCO bond, then it is also eligible for 54EC as an exemption of. Yes, a very specific amendment for Jan 2025, which means you would have not read this until your September 25 modules as well. Sorry, this is not Jan 25, this is Jan 26. Yes, so you might have not learned this until your September modules as well. You will look at this only for the first time in your Jan amendments. Yes, so this was a part of the statutory updates which came in just now. I'm just putting it out to you so that you understand this very specifically. Yes, perfect. 54EC is also done, people, which then brings me to the tax rate computations. I think this is what you're already discussed off with me in chapter number 2, where we discussed that when it comes to tax rates, you're going to split your capital gains into two parts. One is going to be long term, one is going to be short term. If it's going to be long term capital gains, you were earlier taxable for 20%, now you're taxable for 12.5. If it is 112A, you were taxable for 10%, now it is 12.5 in excess of 1.25 lakhs. If it is going to be 111A, then it was 15 earlier, and now it is 20%. But yes, like I said, people, the most critical amendment is that if you're going to have a resident individual or HUF which is now going to transfer any kind of assets post 23rd July, then I will be eligible to compute taxation as per the old rules of claiming indexation and new rules of without claiming indexation, and then checking whichever is lower. Not expecting at CA final level, but nevertheless a very good thing for you to keep in mind. Yes, the same thing has been confirmed, which happens before 23rd July. So what happens before 23rd July, what happens after 23rd July is what has been given to you. We will not be discussing this here, people. I will be discussing this very specifically with you when you do non-resident taxation with me. Yes, so let's wait on this until we reach non-resident taxation. You will have a better grip and understanding on this topic of there. Clear? Yes. So from an exam perspective, if you feel like you want to ignore this off, you can completely ignore this off. If you already know the tax rates from chapter number 2, you can focus on the non-resident taxation, and the non-resident taxation piece will already give you the answers on all these topics off. You don't have to pay too much attention to this. Yes, perfect. Moving on to the next and the most critical amendment, people. Now, this has already been tested in September examinations. So the likelihood of January students getting this for CA final is very, I wouldn't say is not possible, but I would say little remote. Yes, this is more important for my December 25 students who are appearing for CMA final. The amendment of current year comes and clarifies that if you are going to initiate any kind of buybacks, until last year, buyback was treated as a capital gains. But from 1st October of the current year, if a buyback is initiated, then whatever money you receive in the buyback will be treated as full value of consideration. Every single rupee that you receive is a full value of consideration. Rahul, what happens to my cost of acquisition? Income tax says treat the cost of acquisition directly as a capital loss. You treat it as a direct capital loss and you move forward, people. You will not treat anything otherwise. Yes, which means the only change which has happened is last year you would do capital gains as sale value minus cost value to arrive at profit. Now what you'll do is you'll take the sale value, directly put it under deemed dividend IFOS, and take the cost value and put it under capital loss. That is what you're going to do. So if I have to summarize this, people, it looks like this. I am going to have a buyback. Whatever is my full value of consideration, I will simply straightforward take it under my deemed dividend as a concept. Yes, so I will treat it as an IFOS income, whereas whatever is my cost of acquisition will directly go on to become my short-term or long-term capital loss, which I can adjust against my long-term capital gains if I am having a long-term capital loss, and any kind of gains if I'm going to have a short-term capital loss. Here, two things are very critical. One, you cannot claim any other expenses. Yes, two things only which you can claim is your sale consideration, one is your cost of acquisition. Any other expenses which you have, no expenses can be claimed under your IFRS chapter of. Second, this provision will apply irrespective of whether you have any accumulated profits. Normally everyone discusses the fact that when it comes to dividends, dividends can only be taxable when you have accumulated profits. Here is a case where I don't care what and all profits you have, every single rupee of the full value of consideration is taxable as dividends, even if the company has no accumulated profits. Yes, I tried putting out a question for you people. Let's see if you understand the question carefully. The question simply comes and says that there is a company called Hudson Private Limited. This Hudson Private Limited has decided to buy back 50,000 equity shares by Mr. C at a price of 12 rupees per share, which means the company has decided that they are going to buy back the shares at 12 rupees per share when the accumulated profit of the company was 4 lakh rupees. People, company's total accumulated profit is 4 lakh rupees. Mr. C had acquired the share for 15 rupees. Now, if you notice, Mr. C acquired the share for 15 rupees, which means that becomes his cost of acquisition. This cost of acquisition will directly go ahead and hit my capital gains as a loss. Yes, so I will take this 15 rupees multiplied with 50,000 shares. So take the 15 rupees multiplied with 50,000 shares. Answer gives me 7 lakh 50, directly goes and hits my capital loss. On the sale price, which is the 50,000 rupees into 12, which is the 50,000 rupees into 12, I will take, yes, 50,000 rupees into 12, which is nothing but 60 lakh rupees. The whole 60 lakh rupees will directly become my deemed dividend. I don't care what, sorry, not 60 lakh, 6 lakh rupees. The whole 6 lakh rupees will end up becoming my deemed dividend. I do not care what is my accumulated profit. My accumulated profit is of no relevance to me. I will straightforward ignore my accumulated profit. Even if I have less accumulated profit, or even if I have a loss, my buyback dividend will continue to apply. So I will treat my buyback dividend as it is. Yes, so the buyback price of rupees 6 lakhs will have to be taxable as dividends in the hands of Mr. C, irrespective of your accumulated profits. The cost of acquisition of 7 lakh 50 will now be treated as a long-term capital loss because asset was purchased for more than 12 months and to be set off against long-term capital gains within a period of next 8 years. This is what the provision will come and clarify. Yes, so please keep this one as adjustment. Very, very nice adjustment, people. You got this adjustment in September examinations, which was really helpful for you to prepare on. Yes, so December CMA final students should pay more attention to this. Jan 26 students, yes, you may get an exam question, but since I've already seen this in the paper, I don't expect this to be of critical importance for your examinations, at least to start with. Clear? Amazing. What I do expect for Jan 26 students is the provision of chapter 22, assessment of firms. In the current year, income tax has come and clarified that if you are going to be a partnership firm which is going to distribute salaries to your partners, the book profit computation has changed slightly. Computation of book profit now comes and says for the first 6 lakh rupees, you will be eligible to give 90% or 3 lakh rupees, whichever is higher. Yes, until last year, the rates were half. So which means it was for the first 3 lakh rupees, number was 1 lakh 50. Now the number is 6 lakh rupees, 3 lakh of the computation. So for the first 6 lakh rupees, you'll be eligible to claim 90% or 3 lakh, whichever is higher. And then for the balance, you can claim 60% as usual. This is your computation on salaries for the purpose of partnership firm. Yes, if I have to give you out a small example, the small example is going to look like this. Imagine if the book profit of the firm has been declared to you as 10 lakhs. If the book profit of the firm is declared to you as 10 lakhs, what will they say? For the first 6 lakh rupees now, I will be eligible for 90%, which is 5 lakh 40 or 3 lakh rupees, whichever is higher, which means I can claim 5 lakh 40,000. For the remaining 4 lakh rupees, I am now going to be taxing it as 60%, which is 2 lakh 40,000, therefore giving me a total salary of 7 lakh 80,000. So up to 7 lakh 80,000 is what I can claim as salaries for the purpose of partnership firm giving away to the employee, giving away to the partners. So a partnership firm can maximum claim 7 lakh 80,000 as an expense to the partner's salary. Anything excess will get disallowed in the current year. Are we clear? Yes. Amazing. This is what the amendment is, people. Please expect a question relating to this in question number 2, which is nothing but your assessment of firms along with AMT computation and other issues. So please keep this in mind. You are expecting a question in question number 2 for this. You may get a partnership firm question where they may come and ask you for these kind of models. So please be very careful on the computation of book profit for the current year. Yes. Now there are some beautiful questions in the solutions guide, people, where they will try to manipulate you a little bit more, where you will see that when it comes to book profit computation, you also need to keep in mind that yes, there are some other adjustments to be taken up. Yes. So book profit computation itself means that you have to take the total PGBP answer, but just claim unabsorbed depreciation from it. So take your whole PGBP computation, ignore of this salary, and then take an unabsorbed depreciation on it. If you do that much, you will be able to get the book profits properly for your computation purposes. Yes, so please be very careful on this. You should take book profits as PGBP income of the firm, taking unabsorbed depreciation into consideration, but ignoring the salaries of. So please be very careful on that as a computation model. Yes, yes, very good. After the assessment of firms, people, comes in the non-profit organizations. Now, thankfully, in the current year, NPO has very small amendments in the current year. So this year is the first time when NPO is not being paid too much attention to. The amendment in the current year as follows. Normally, people, when it comes to charitable organization, it's clarified that in charitable trust, you cannot claim any exemptions other than the one which you're looking for, which means you can only claim an exemption of section 11 and 12 when you're opting for it. No other exemptions will be permitted to you except for one item, which is called as agricultural income. So agricultural income was the only exemption which was being clarified to you until last year. The further clarification in the current year is, if you are a person who's already registered in other schemes like 1023C, like 1023EA, like 1046A, like 1023ED, like 1023EC, all these exemptions will also be denied to you from the current year. Yes, you cannot claim these exemptions also in the current year when you're already opting for section 11 and 12. If you're opting for section 11 and 12, all these kind of exemptions will automatically become inoperative, which means the only course of action for you would be to apply all the money which you received by 85%. The point is basically coming and clarifying that these exemptions will no more be applicable to you if you are going to opt for section 11 and 12. If you're opting for section 11 and 12, all these will automatically become inoperative for you and can only be revived if you decide to come out of 11 and 12. That is what the amendment comes and clarifies. Nothing critical, people. You don't expect questions on this in examinations. The MCQ question which I am expecting in examinations is here. The MCQ question of examinations will be on the fact that when you're going to apply for a registration, income tax now comes and clarifies that all the people who are going to apply for a renewal of registration, if you're going to apply for a renewal of registration or a final registration, the due dates are now extended to 6 months from the end of the quarter for the officer to pass the order. Yes, once again, people, when you are going to apply for any final registration or any new registration, in that case, the due date for passing the order by the assessing officer has been extended to 6 months from the end of the quarter. Please notice this, it is 6 months from the end of the quarter, which means if I have taken an application in the month of April, May, June, ignoring these 3 months, start 6 months from there. So July, August, September, October, November, December, 31st December becomes the due date for the officer to pass the order granting you the final or the renewal of registration. Yes, so you'll see the same point getting repeated of for final registration, you'll see the same point getting repeated of for new registration, you'll get the same point being repeated of for renewal of registration. These 3 places, it is 6 months from the end of the quarter in which the application is filed off. That is the only amendment which is there in charitable organization. Other than that, whatever you have learned remains as it is, people. No changes in charitable organization. Trust me, one of the most easiest chapters and a short question in exam. You should be able to answer it as it is for whatever it's worth. Clear? Yes, good. With this, I am done with volume 1 of my study material. Yes, volume 1 of my study material is done. I'm going to do some more points of the volume 2 today itself, people, and then we'll take it off in the next part of the discussion so that you have a better understanding on things. Yes, volume number 2. Volume number 2 of study material now talks about chapters on administrative guidelines. First is on the TDS part of the amendments. Very few places you will see TDS related amendments which has come in, people. First amendment is on the section 192. Section 192, which talks about salaries, had an amendment in the current year which came and clarified that when an employee wants to declare his credits to the employer, he can now also furnish his TDS or TCS credits. He will be perfectly permitted to furnish his TDS and TCS credits as well to the to the employer. Yes, this was a question which was tested in your September 2025 examinations. September 2025 had a question relating to the section 192 where they were trying to talk about the fact that an employee is going to give all his information to the employer. Which ones should the employer consider and which ones should he not consider? Yes, so this was an amendment coming in from there. So please pay attention to that. Again, because it is already tested in September 25, the chances of it being tested in Jan 26 for my CA final students is little remote. remote, people. It's a little remote. I don't expect this very significantly enough for your examinations, but rather than that, it's a very easy amendment. So there is nothing much for you to focus upon also. Yes, the amendments which I want you to understand carefully is all your amendments where income tax has come and clarified that anywhere where the rate was 5%, anywhere where the rate was 5%, all those places the rates have now been trimmed down to 2%. So income tax now comes and clarifies that in sections like section 194DA, which talked about life insurance policy proceeds, sections like 194G, which talked about your lottery commission, sections like 194H, which talks about normal commission, sections like 194IB, which talks about any person who's going to take a property on rent as an individual or HUF not liable for 194I, section like 194M, the provisions which come and clarify that if you are a person who's not covered under 194C, 194H or 194J, in that case you will be applicable in this section. All these sections now come and clarify that the rate of 5% which you have will only apply up to 30th September. Will only apply up to 30th September. Starting 1st October, your rate is now going to become 2%. Your rate is now going to become 2%. So please be looking at this carefully, people. You are now going to be looking at a rate of 2% starting 1st October in all these examples of. Yes, so you now have a 2% rate coming for all these examples of. So one simple thing to be kept in mind in exam, that whenever you see a rate of 5% earlier, strike to the fact that if it is after October, you are now going to apply for 2%. There is only one exception, and I think this exception has already been tested by ICAI in the May examinations. The exception to this rule was a drafting error from income tax on section 194D. There was a drafting error from income tax on section 194D. Section 194D was basically insurance commission. Insurance commission is remaining at 5% even post October. Yes, so an insurance commission case will alone be remaining at 5% post 1st October as well. This is something which was not amended because there was a poor drafting error from income tax perspective in the current year. Yes, it has been amended in the next attempt, but that's not relevant for you. So for your attempt, you're going to keep in mind that every case where there was a 5% rate, now it only applies till 30th September. All those rates have been amended to 2% from October, except for one item, which is 194D, talks about insurance commission. Are we clear? Yes. Then two critical amendments, people, apart from that, is section 194IA. Now the section 194IA did get tested in your September examinations. So again, I don't expect this for Jan 2026, but nevertheless, the amendment basically comes and clarifies that when you're going to buy an immobile property, you need to ensure that if the consideration value is rupees 50 lakhs or more, then you are liable to deduct TDS at the rate of 1%. Yes. Now, the amendment of current year clarifies that I will continue to do this 1% TDS deduction irrespective of how many owners are there in the property. If the property value is more than 50 lakh rupees, then all the persons part of the property will be liable for TDS. Yes, a beautiful question which came up in exam, people, was a case where what happened is an assessee was going to buy a property from a husband and a wife. The husband had about 47 lakh rupees given to him and the wife had about 47 lakh rupees given to her. In this case, the question came up is, should I be doing TDS or not? Because on an individual party level, I am seeing that payment is only 50 lakh rupees. Here is income tax coming and clarifying that even though the individual party level, it may be 50 lakh rupees, it may be less than 50 lakhs, but if I consolidate both the parties and I look at the property value, it was more than 50 lakhs and therefore TDS should apply on the complete payment of the property. Yes, so the provisions are what, people? The provisions come and say where multiple transferor and transferee are involved, the threshold limit shall be looked at an aggregate level of all the property value. At an aggregate level of all the property value. That is what the amendment comes and clarifies. Clear? Yes. Good. The expectation from my side on the examination, people, is on 194O. The amendment of the current year of 194O comes and clarifies that a person who was earlier liable to do TDS at the rate of 1% on e-commerce transactions will now only do at the rate of 0.1% starting October. So the rate has been trimmed down by 1/10. Yes, so a person doing 1% earlier is now going to do TDS at the rate of 0.1% in the current year. That is the amendment of section 194O for e-commerce operator. So expect an e-commerce operator related question in examination, people, because everything else has now been tested in examinations. This is the only cheese which is pending in your examination. So Jan 26 has a high possibility on this as a provision of. Yes. Yes. So what are the amendments in TDS, people? Quickly discussing of amendment number 1. When it comes to salaries, any person giving any TDS credit to the employer will now be considered by the employer. Second, every places where you had 5% rate has now trimmed down to 2% starting October. Third, if you are going to go to 194 IA, buying a property value should be more than 50 lakhs for the property, not for individual owners. And fourth, if you're going to go to 194O, the rate has gone trimmed down from 1% to 0.1%. 0.1% starting October. Yes, yes, great. This is the amendment when it comes to TDS. Clear? Good. Other administrative provision TDS amendments, people. One is that when it comes to electronic processing of TDS returns, until last year there was no time limits on how you can revise your TDS returns. You can revise TDS returns for any number of years. Starting current year, the clarification says you can revise the TDS return only for a maximum of 6 years from the end of the financial year. So in the year in which I filed the TDS return, from that year I will go for the end of the financial year and I have to file the TDS return revisions within 6 years. Going beyond 6 years, no TDS return options are available to you for your syllabus. Clear? Yes. Next, last thing, people, is on the penalty. Penalty of income tax now comes and clarifies that if I am going to levy a penalty to you for not furnishing a TDS return on time, that can only be levied if the delay is more than 1 month. Yes, the provisions of the current year now comes and clarifies the delay of 1 month. Earlier, this was a delay of 1 year. So there was a delay of 1 year, then only penalty would be levied. But now, even if you delay for more than a month, then in that case, income tax will levy a penalty somewhere between 10,000 to 1 lakh rupee. Somewhere between 10,000 to 1 lakh rupees. So please expect a question on this in exam, people. I at least feel this is very important for examination. A very small thing which students end up normally missing out because technically they don't find this very relevant. But I do expect a question on this in exam if a penalty question comes up. Two things you'll have to keep in mind. One is that yes, the delay has to be more than 1 month, and second is that the penalty will be somewhere between 10,000 to 1 lakh rupees for you to cover this penalty off. Clear? Yes? Perfect. Moving on forward, people, to the return filing things. This is an amendment which I really hope should come as a part of your MCQs this time. Yes, ICI normally has a practice to play around with these numbers on a MCQ format. So I am looking forward to this as an adjustment of what is the amendment. The amendment of the current year comes and clarifies that when it comes to any kind of person who has made a delay in his return filing, you are unfortunately liable for some consequences. If you do not file your returns on time, your losses are lapsed off. At the same time, you will not be eligible to claim your refunds off until you file a return. To ensure that that does not cause hardships to the assessees, there are some condonation provisions. Condonation provisions basically used to come and clarify that depending on the quantum, you can ask for an application from the officers in order to condone your delay and approve your filing of returns. Until last year, the limits were very small and the most of the powers were remaining with CBDT. However, with the amendment coming in as a part of the circular, the amendment now comes and clarifies that if your claim is going to be somewhere between 1 crore, if your claim is somewhere going to be between 1 crore, then the PCIT or the CIT can approve the case of the principal commissioner, and the commissioner can approve your case of for condonation of delay. Where it's going beyond 1 crore and up to 3 crores, then the CCIT will have to intervene to make the approval for you. And where it goes beyond 3 crores, I don't need to approach a CBDT anymore. The PCCIT itself can take charge. The PCCIT itself can take charge, which means the principal chief commissioner of income tax sitting in your jurisdiction itself is sufficient enough to approve the condonation of delay. You don't need to approach CBDT for getting the delay condoned off. Your local officer itself can do that matter for you. Yes, that is the amendment of the current year. But apart from that, the second amendment is that if you want to get this as a claim, then you can only do it within 5 years. Which means the period has now been trimmed down from the earlier 6 years to 5 years. You can only make an application within 5 years from the due date in which the return has to be filed. If you have not made that, then no application can be filed off. Yes, so it is 5 years from the end of the relevant assessment year for which the delay has to be condoned off. Only for that period can you apply for a condonation. If it is going beyond the 5 years, you can forget the condonation. You will not be eligible of. You can be liable for penalties and prosecution consequences. Yes, that is what the return filing provision is. So please keep this limits as very important, people. Less than 1 crore become PCIT and CIT, 1 crore to 3 crores become CCIT, and after 3 crores you end up at a PCCIT level for you to condone your delays of us. Is that making sense? Is that making sense? Clear with me? Perfect. That's next amendment, people, is on the 244A. The 244A provisions, as you all would be aware, that when you apply for a refund, if the refund is more than 10% of the tax payable, the officers are bound to give you 0.5% per month or part thereof until the date the refund is granted to you. The amendment of the current year clarifies that I don't have to give you interest for a certain restriction cases. What other cases? It says where any refund is due and assessee has any proceedings pending, the assessing officer has powers to withhold the refund after claiming an approval from PCIT or CCIT. Yes, so if I have a PCIT or a CIT, I can approach them and I can say that for this assessee, I would like to withhold the refund of because any proceedings are pending. This can be done up to 60 days from the date on which the proceedings is made. So when the proceedings has been initiated, within 60 days, if I make an application, get an approval from the officer, I will be eligible to withhold the refund of. The problem is for this period, no additional interest will be paid off. You will not be given a single rupee of interest for this period because this is a withholding happening for the benefit of the department. Yes, so this is the critical part for the current year people. If you get a computational question in interest on income tax refund, you will have to know the fact that if the question says that the person has withheld the refund because he wants to use it for other proceedings, in that case, for that period, you will get no interest. It will not be eligible for interest. You can only claim interest after 60 days are lapsed off. Yes, that is the amendment of the current year. Are we making sense on the amendments? Perfect. Amazing. This gives me the assessment procedure timelines, people. Assessment procedure timelines, the first thing which has happened is current year has a huge amendment. Until last year, in fact, last year was the first year of amendment. Until last year, people, search and seizure was a different concept altogether. Last year, we ended up including search and seizure as a part of reassessment guidelines. So reassessment guidelines now included the provisions on search and seizure, and from the current year, that has also been deleted off. So from the current year, what has happened is survey matters are remaining as a part of reassessment guidelines, but all search and seizure parts now have a separate concept called block assessment. Yes, so a separate block assessment concept has now been introduced for you to complete your search and seizure of any person other than search and seizure will sit in reassessment guidelines. Yes, so the first amendment you're going to notice is here. The amendments come and clarify that when you talk about income escaping assessment, any information which is coming from a survey conducted under section 133A will also now be treated as income escaping assessment, eligible for claiming, eligible for officer to reopen your case of. Yes, so during the course of survey, if there is anything which has been found out by the assessing officer can use that also as an evidence for you to treat him a reassessment guidelines, and income escaping assessment procedure can be initiated off. Yes, so now survey is part of reassessment guidelines and is not part of survey search guidelines, Clear? Amendment number 2. This is more like a clarificatory words, people. There is nothing great about this. 148A, which talks about giving an opportunity to the assessee before the reassessment proceedings is initiated, now comes and says that when the assessing officer has information which suggests that the income has escaped assessment, more of a clarificatory words, where they're saying I should have information which suggests that there should be an income escaping assessment, which means I can't make a guess. I should have materials in my hand in order to prove that I have income escaping assessment. Point number 1, after he providing an opportunity to him, he will show cause a notice to him under section 148 why it should not be issued, accompanied with the information suggesting, which means now it is mandatorily for assessing officer to give you that information. He needs to come and tell you on what grounds is he coming and reopening the case for you. In what grounds is he wanting to reopen the case for you is what he has to confirm to you. So it's to give you the document, which has to, he doesn't have to give you the document, he probably has to submit the information to you and come and tell you this is the reason you were picked up in survey. You have some information coming from section 1991. There are some other things based on risk-based strategy based on which I have picked you up for assessment. These are the issues which are coming up. How will you show cause yourself? Do you plead guilty, or would you like to substantiate on what mistakes have happened here? Yes, that is what is the confirmation right now. So they have to accompany with the information. That is a mandate. Notice has to have the information. If it does not have the information, then it is not valid. Second, consider the reply of the assessee within the period specified in the notice. They have now come and confirmed that what is the period within which assessee has to confirm the thing is not something which will be clarified. It is something which the assessing officer can decide in its own capacity. So an assessing officer can tell, I want the response within 10 days, 15 days, 30 days, 2 months, 3 months, anything for his matter. As long as he can satisfy the timelines of completion of assessment, it doesn't matter. He can ask for any number of time period. Yes, so this is now powers delegated of the assessing officer to decide as to when does he want the response back. Third is that after using all this information, the assessing officer can decide whether the materials are good enough. Would he want to drop the proceedings, or would he like to now initiate the reassessment proceedings by issuing a section 148? For doing that, he will have to pass an assessment order under section 148A. Yes, he may have to pass, it's not an assessment order, but nevertheless he has to pass a reassessment order under section 148A confirming that he would like to reopen the case of under 148. Yes, so what has been changed, people? First is that whenever I'm going to do 148A, I need to have information in my hand which suggests that the assessee has escaped assessment. This information has to be passed on to the assessee while issuing the 148A notice show cause, and then I have to give him time so that he can respond back. This time limit is not defined, it can be taken up by the assessing officer on his own free will. That is what the amendment is. Yes, good. What is the other issues? Other issues is when it comes to says, when I start issuing a notice under section 148A, income tax says, the 148A now comes and clarifies that assessing officer, when he asks the assessee to to file a new return, under section 148A, he can confirm as to what is the period he wants assessee to look into. He can confirm as to what is the period in which he wants assessee to make this filing into, which means now there is no prescribed period. So assessing officer, when he issues the 148A, can come and say, I'm issuing this 148A, please file your income tax return once again. I am giving you 10 days time, 15 days time, 20 days time, whatever time I want, I can give it to you. This time limit should not exceed 3 months. This time limit should not exceed 3 months from the end of the month in which the 148 notice is issued. So which means any time I want, I can give it to you, but it should not exceed 3 months for the time limit period. Yes, last amendment, people, of the current year, which says where the information is received through faceless collection of information, notice shall be issued only after getting an approval from specified authority. If the faceless collection of information during a discussion phase like 133(6) has come and confirmed that yes, there is a possibility that this person is escaping assessment, then I will only be able to issue a notice under 148 when the specified authorities approve this off. What is the specified authorities? Separate topic, we will discuss about this. Yes, so that is what the amendment is. Now, what do I want you to pay attention for 148, people, is the timelines of the current year. This timelines is now extremely critical for you to pay attention on. What are the timelines which are required for a reassessment proceedings to happen? Income tax says if a notice has to be issued under section 148A, the original thing for you to reopen the case of, then the notice has to be issued within 3 years. The notice has to be issued within 3 years. After that notice is issued, people, because I need to issue a new notice under 148A, 148, that will be done in 3 years and 3 months, which means I have to issue the 148 notice by 3 years and 3 months, and I should issue the 148A notice by 3 years. This is an indirect way of coming and telling that for me, going from 148A to 148, I have 3 months timeline. I cannot go beyond 3 months timeline. I will not be permitted to do so. It's an indirect way of coming and telling you that. Yes. So for the general cases, I should issue the notice by when? I should issue the notice by 3 years for 148A and 3 years 3 months for 148. Next, if I am not going to be a general case, it's going to be a case where my taxable income has escaped assessment for more than 50 lakh rupees. If I find out that my taxable income has escaped assessment for more than 50 lakh rupees, the 3 years now becomes 5 years and 5 years 3 months. The 3 months remains the same, but the 3 becomes 5 years now. That is what the provisions come and clarify. How does this work, people? I have a small table for you which should help you understand this better. The table comes and says that when it comes to 1819, if you notice 1819, I go 3 years. It becomes 20, 21, 22. Already time crossed. I do not have any period coming up in previous year 24, 25, which means time limit is crossed, cannot be issued. But if I'm looking at 5 years, look at it. If I look at 5 years, it will be 20, 21, 22, 23, 24. So I can issue it up to 31st March 2024. Yes, 31st March 2024 is when I can issue this. But because there was an amendment which happened from September, people, income tax comes and clarifies. Amendment happened only from September, so therefore I cannot expect you to take care of the old provisions. You cannot suddenly lose attention to this. So they gave time until 31st August 2024. Yes. Next, if I am in 1920, again the same thing. Looking at 1920, I have 21, 22, 23. Time limit for 3 years has crossed. But if I am in the case where I am crossing this limit of 50 lakh rupees, I have 5 years timeline. So with the 5 years timeline, it becomes 21, 22, 23, 24, 25. I have time until 31st March 2025 to issue my 148A and 30th June 2025 for issuing my 148. Yes, so that is what my timeline is going to be. This is correctly falling in your previous year of discussion. Yes, so this is what you're going to expect in your examinations, people. A question relating to assessment year 1920. If you see a question coming up for assessment year 1819, you will only be allowed to issue it for the 10 years timelines with the 31st August 2024 as the cutoff period. But if it is 1920, it will correctly sit for 148A in your current year. 148 will be done in the next assessment year. Next, if I'm in 2021, then it automatically shifts off to the next year's people, which is not relevant for your examinations. But what is more critical is that if I am at a person who's having an escaped assessment less than 50 lakh rupees, then 21-22 is the first year of my discussion. In 21-22 is what I will be eligible to issue the notice as an assessing officer. My timeline will become 31st March 25. Yes, so 22 and 22 will have 23, 24, 25. So 31st March 25 is the timeline within which I can do this, and therefore that is the period which I have to consider in my picture. That is the period which I have to consider in my picture. Any doubts on this part? Are we clear? Yes, so be very, very careful on this as an adjustment of. A very good example, people, focusing on two things here. One is on the 1920 and one is on the 21-22. 1920 for the 5 years case, 21-22 for the 3 years case. Clear? Yes, perfect. Now comes the question, Rahul, who is going to sanction the notice? Income tax says the sanctioning of the notice from the current year will happen by these parties, which is additional CIT or JCIT or additional DIT and JDIT. These are the only parties which can issue the notice to you for which can approve the sanctioning of the notice under section 148. That is what we discussed earlier, right? So if you want to issue a notice under section 148 or 148A, the approvals will be given by additional CIT or JCIT, additional DIT and JDIT. This is what a reassessment timeline procedure, people. So quick revision on reassessment timeline so that we do it together. What is reassessment timeline provision? It says going forward from 1st September, if there is any survey happening, that survey is also part of reassessment timelines, and that can be used as an income escaping assessment for the purpose of issuing 148A. Second, if I'm going to start issuing 148A, two things to be kept in mind. One, I need to have information in my hand which suggests that the income is escaped assessment. Two, this information has to be communicated to the assessee when you are giving 148A, showing cause why you should not open under 148. Third, you can give any amount of time to the assessee to respond back on the case, but with this timelines, you are one thing very clear, that you cannot go more than 3 months. You cannot go more than 3 months. That is what this timelines would come and clarify. At the same time, people, if I'm going to have any faceless collection, then I need to mandatory get an approval from additional CIT, additional CIT or JCIT, additional DIT or JDIT. My time limits of the current year are as follows. If I'm going to issue any notices, I have to issue the notices within 3 years, and 3 years 3 months if I want to issue the 148 notice. But if I'm going to cross my escaping assessment for more than 50 lakh rupees, then I can issue notice up to 5 years or 5 years and 3 months for 148. That is what the timelines is. For anything which is expiring for 18-19, the time limit has been extended to 31st August 2024 for me to consider this as a provision change. Yes, that is what the provisions are. Any doubts on the provisions? Amazing. Last few things, people, for me to complete of assessment topic. The last thing which is there in assessment of topic is that they have come and confirmed that when any assessment order is passed for a consequence of 119(2)(b). What is 119(2)(b)? This is the condonation case. This is the condonation case. So if I've gone to my CBDT and I've asked for a condonation case, and if the assessment order has been passed by the CBDT to approve my condonation, in that case, the assessment of this year will be completed 12 months from the end of the financial year in which the return is furnished. After I furnish my return, people, 12 months timeline will be extended off for the assessing officer to pass my assessment order off. This is something which was done in order to ensure that an assessee does not escape assessment after he has filed a return. When I'm giving him additional time for him to file his return, that day he should not come back and say that you should only check for my assessment from the original return due dates. When I have not even filed a return earlier, that should not be the defense line from him, which means if now he has filed a return late, I can also open up assessment after this return has been filed off. So it is 12 months from the end of the month in which the return is filed. This is what is the amendment of the current year. Now, yes, I don't expect this as an amendment very, very importantly for your examinations. Clear? Yes. Perfect. With this, people, we are almost done with chapters 35. We are done with up to chapter 35, so all the amendments which are there. I know I am at 115 hours, so I don't want to take any further thing in this video. I think this is already enough heavy information for you to go through yourself. So why don't you take a step back, go through all the information which you have understood with me till now until chapter 35. Do a quick revision, try to implement it once in a while and look for some examples and see if you understand it. If you're confident enough that you understood it, we will come back in the next part of the videos and we'll be discussing on the balance adjustments. From here starts the most critical adjustments. Your search and seizure related important topic, your compounding procedure which is there in penalties, and the last most critical amendment which has come in is something called as safe harbor rules. We'll be discussing all those things in the next video, people. Until that time, I want you all to look into these videos once again and understand every single amendment which is there before you pay more attention to it. Now, I have tried my level best that every time I looked at a PDF, I have tried to mark a few things here and there. I hope you can also take a printout and mark it to the same extent so that you only have to read that much amount of information for your examinations. It was my responsibility to put everything and give it in this PDF so that you understand the before and after. But if you are already understood the topic, I think for examinations, reading just the lines is going to give you the sufficient information you want for your examinations. Yes, so please use this PDF to the best extent possible. And yes, I will see you all in the next video. Until then, take care. Bye bye.